Probably all thinking about coffee now, so hopefully it won't keep you too long. I know it's a pleasure to be standing up after an hour here anyway myself. So what I want to share with you today is some, I suppose, facts and some insights into over a decade of studying and looking at the Irish software cluster, and from a finance point of view primarily, because I'm interested primarily in finance. And unlike the other sectors in the Irish economy at the moment, this is one sector actually that's not under the spotlight. It'd be nice if it was, in fact, because I think it's a sector that needs a lot of attention. That's the venture capital sector. It's been very successful over the last decade, and we've had some very successful companies in the sector supported by it. But there's still some work to be done. So to sort of take a slogan that was once used by Bertie Ahern a long time ago, a lot done, more to do. But there is a lot done here and more to do in the VC sector, and I think it can be achieved. So to just briefly introduce the notion is that I'm going to talk a little bit about the importance of equity finance, just to start, I suppose, because I think we have a mix of people today, academics and industry people, so I just want to talk briefly at the beginning about why we should be interested in equity financing, because it is fundamental. It's essentially, equity is a technology phenomenon. It's fundamental to the technology sector. And more importantly and more recently, most of us who would be active in this area recognise that it's fundamental to the comparative advantage of nations, particularly those who seek to produce high-tech goods. There is no two doubts about that. There is no doubt about that. So if we look to the States, I suppose, where we always do, we see that in building the boom and the technology boom in the States is driven primarily, by public markets, which you usually see and we're used to seeing, but there's a story behind those public markets as well, and that's the story of private equity in the form of private investors and also venture capital. So that even though venture capital makes up about 1% of all investments in industry in the US, those venture capital-backed firms are much more likely to go to IPO. So if you're looking at your stock market in 2009, vis-a-vis 1999, you're hoping, that in terms of the long-term growth of your economy, that you've brought some technology companies to the stock market in that decade. And I suppose that's one of the things that we might look at in Ireland's case, and we'll come back to this, and one of the things that is important, I think fundamentally important at the end of my talk, is that the role of IPOs and the importance of them in terms of scale and in terms of Ireland moving forward. So private equity is important. It's important because it facilitates the IPO, it facilitates scale. It really, really does. And if we come back, I suppose, to Finance 101, lecture, why is equity important? From a firm's perspective, if you're a venture capital, or if you're a technology company, and particularly if you're in a software company, and particularly, in the early years of this decade, it was very difficult to get bank finance. So you had to be looking at private investors, you had to be looking at venture capital. And primarily because there's high risk involved. There's high and variable returns. And then there's the problem of asymmetric information. The fact that banks particularly just find it difficult to understand technology companies. Our training in banks in Ireland has traditionally been in sort of traditional banking. They don't really understand the technology market. And as I said at the beginning of is that equity is important for size. If you want to get scale, you're going to need equity. Venture capital allows companies. If a small software company gets $1 million in venture capital, it's got some assets. It can also go out and possibly borrow against that. So size is important. If you want to grow and if you want to be big, you're going to need equity. If we look at it from an investor's point of view, we also want to look at the factors that are important from their point of view. And really, when you come to the investor side of this argument, there is this concept of an equity gap, of whether or not there's equity available in small parcels for around sort of $1 million or $2 million. That difficulty of supplying equity at that sort of size level is problematic. And again, it's a size question here, because equity, it's difficult to supply equity in small amounts. And new and small businesses tend to require small amounts of equity in the beginning, and their demands are lumpy as well. They tend to look for $1 million this year, and they might look for $2 million down the road. And that's difficult for investors, for institutional investors, because if I've got 10 $1 million investments, I've got to look after those and monitor those in the same way as I monitor my one 10 million investment. I've got to go out, I've got to do my audit and look after each of those 10 companies, even though I'm only giving them $1 million. So there's a scale question involved from the investor's point of view, and it's expensive to do that, to monitor. So I suppose one of the reasons why then we have developed our venture capital markets in Ireland is from that point of view, that rationale is that you need to supply equity to technology companies that find it difficult to get funding from banks. And we've had major expansion in this sector in Ireland over the last decade, particularly about 2.5 billion invested in total. So we've done very, very well vis-a-vis other countries. So it's a success story. And we've been looking in Ireland as well in the sense that a lot of it has gone to startups. But the question is, if this is important, then how much do we know about venture capital-backed companies? And from my research, particularly from an Irish perspective, and it's not just in an Irish case, is that we know very, very little. In fact, we know very, very little about the financing of high-tech start companies in general. So, and this is also matched by a lack of sort of theory-driven research in the area. And it's not just in Ireland, it's globally an issue. So what I want to first present to you is results from one of my first study, which was in 2002, which was looking at the entire software product sector in Ireland. In other words, this is software product companies that were existing in Ireland at that particular time. And there were about sort of 257 of them there that we could locate. And we sort of looked at their financing. And what we can see here, okay, this is for the group, globally speaking, is that banks only accounted for 4% of their financing. So this is young and old companies represented here. Most of external finance coming from venture capital, 28%, 11% from private investment, private investors, and 7% from grants, and then the rest coming from internal sources. So that's globally for the 96 firms that of the 117 that returned. That's what their finance looked like. If you go to startup, obviously you're going to find less venture capital involved, you're going to find less private investors, but you find no banks, and that's generally the case. You're finding that they're primarily funded from internal sources. That be either the owner's funds, some consulting revenues that they might have earned as well. And consulting revenues were very, very important to these companies in terms of internal sources. And I won't go into that today, but it's another part of our research. If we go to the commercialization stage where these companies tend to be, and this is firms between 2 and 4 years old, we find that, okay, venture capital is really, really important here. So it's making up 38% of their funding. Private investors, again, 18.5%, grants, 8.5%, and banks, 3%. So banks did not feature, okay, in producing the software cluster in Ireland. Very, very insignificant in terms of the funding involved. And that's been really the story from there. What else did we learn in our research? We also looked at, well, what factors were determining whether or not you got venture capital backing or not. And I suppose I should say at this stage, okay, about 50% of these companies were venture capital backed. The others had private investor funding. So if they didn't have venture capital, a lot of their funding was coming from private investors and also from consulting revenue. So if they didn't get venture capital, they had private investors on board, or they were using consulting revenues as well. So we looked at these sort of 8 determinants of sort of whether or not you should get venture capital backing, whether you had more than one founder, educational background, whether you had prior startup. Did that mean you'd get venture capital or not? If you had prior startup experience, the product lead times. And we also looked at startup costs, and we looked at preferences for maintaining control of your business and prior experience in the software sector. And of those sort of 8, we found that 3 of them were important, particularly 7 and 8. And I'm going to look at 7 and 8 in particular here today. And what's important is, again, is this question about size. Size does matter. So the firms that had large startup costs, in other words, required a large investment, were much more likely to get venture capital. And that goes back to my early argument, which sort of says for venture capitalist investing, they are interested in larger investments as well. So venture capital is a scale activity. And also, more importantly, the venture capital-backed firms tended to grow faster and they tended to be larger as well. So they were on average about 50% bigger in terms of employment than the non-venture capital-backed firms. What is interesting, and which won't follow through in other sectors, particularly, say, in engineering, and most particularly in the pharmaceutical sector, is that product lead times were not significant here in terms of whether or not you got venture capital funding. And that's because product lead times in software are short. So we actually asked them, we got the average product lead times for these companies, and the median product lead time was about 12 months before they had some kind of beta. So product lead times are less important in terms of driving finance in the software sector. And these companies tend to be able to get to beta production without financing in a lot of cases. Where they really need their funding is after that period, after the first 12 months, when they need to commercialise, is when they really need some funding. So I suppose the question then we want to look at was, and what we're going back to look at now, and it's really only desk research at the moment, we're hoping to continue the study and take it out into the field, is what happened to those companies? There were 257 in the population in total, so where are they now? And the news is good. I mean, in 2009, we see there's about 30% of them have failed. It's not bad. If we look more specifically at the companies that answered my questionnaire in 2002, and we have data for 115 of them, we find that, okay, we've got a 63% survival rate in terms of them still being here. 10% of them were sold. 23% of them failed. 2% of them moved country, and 2% of them I still haven't been able to find. I don't know how, but we will maybe try and track those down as well. Now, we looked at different things in terms of the failure rates, and we looked at things in terms of what was predicting failure in these companies. But what I think was interesting, because as I said, my story is primarily a venture capital story, was to look at the venture capital and non-venture capital-backed firms. And we see here that, you've got 12 venture capital-backed firms that failed, and 12 non-venture capital-backed firms failing here. And you've got 7 of the ones that were sold were venture capital-backed, as you'd expect, and you've got 3 of the non-venture capital-backed firms being sold. So I was kind of interested to sort of say, well, what's the story behind this? So I started to look at the companies, and again, based on secondary information, to sort of see what happened to some of these companies. And I always think it's good because, when you look at large figures, groups of companies, you don't get a real company story behind it. So you have to go to the individual companies to have a look and see what's happening. So we just take an example of one of the companies that was founded here in 1996 that's in the sample, and it raised 25 million. It employed over 80 people, and it went into receivership in 2004 because it ran out of money. And its technology was sold for 1.35 million to the UK, and that technology is still available on the market, and those entrepreneurs are still servicing the companies that were its clients. And this, to me, when I started to see one or two of these stories emerging, I thought I was very worried and very concerned, and I thought, this is the time that we would expect, fundamental growth in this economy, and to see a company like this go, with 80 employees, having attracted 25 million in venture capital, that's really serious, and it's been sold for 1.35 million of this technology. So what was happening? And that's a question I'd like to go out and try and answer. And one of the things that I seem to be finding from talking to people is that we have developed a very good venture capital industry here in Ireland. But there seems to be, when you get to a certain size, some of these companies, you've had venture capital rounds from 1, 2, and 3. You've got very little of your company left. You're looking for more money because you want to grow. There's really no option for where to go because the IPO market is pretty much closed here in Ireland. So it's either trade sale or bust. You're under pressure from the VC to get out now because they want to divest. And some of these companies, still trying to grow, still want to maintain control of their companies, end up going bust because they can't get extra funding. And to prove the point, I suppose, is to sort of say how many of those 257 companies do you think went to market? And it's very, very small. It's only 2 or 3 at the most actually managed to list. And I suppose that's a story that needs to be told, and I think it's very important that going forward that we need to address that issue. Because I think there is, it's great that you get venture capital, it's great that companies can get 5, 10 and get 20 million, but where does the money come to really scale up? And this is really, really important because size matters in the long term, and scaling up these companies. We can sell them. The technology is good. There's no doubt that our technology is good and the technology that we're producing is good. But the problem is, and I think it is a fundamental problem, is that if you trade sale, that technology leaves this country, and that's fine. But what happens is, in most of these companies, that by the time, you trade sale, you're bilocated between Ireland and the US. The vast majority of your people are, a lot of your people will be based in the US, and you see basically those companies that trade sale, you see their involvement in Ireland decreasing within a very short period of time, so that within 4 or 5 years that the Irish side doesn't grow anymore. So the trade sale doesn't facilitate growth locally. An IPO facilitates growth locally, but the trade sale, is basically it's the ending in terms of the company, in terms of major growth at a local level. So those are the questions that I suppose I want to address in future research in more depth. But I suppose some of the conclusions that I want to make, and some questions I might take at the end, is that banks have been insignificant as a source of financing for high-tech companies, and will probably continue to do so. Therefore, it's important that we have private investors and venture capital, fundamental. They account for 39% of total funding in this sector, so we need them. But size matters in terms of VC funding. It needs to be a larger investment originally to attract venture capital funding. But venture capital funding in itself is just not enough to create scale in the long term. Is trade sale the way out? I think maybe not. I think we need to look at we need to look at IPOs, we need to look at that and reopen that issue again for scale in the future. And in some ways what we need is a more integrated market. And so it's not to sort of say that our venture capital market isn't good, it's that our venture capital market has expanded phenomenally over the last decade, but that we need a more integrated financial market that will also take into account the fact that we may have companies that need to grow significantly, and IPO is the only way, in a way, I think, if we're going to keep the technologies and keep growth locally and create scale locally. And I suppose I'll take worship.